Welcome to another edition of Pizz-Spectives. My name is Pizzichetta, founder of Mont Wealth. And over the months, we have met with a number of other advisors as well as new and potential clients. The one takeaway over that time has been understanding that not all advisors are the same and they offer different skills, philosophies, and styles. So today we're going to do something a little bit different. I want to share with you 10 principles that we believe sit at the heart of building and preserving wealth over the long term. What is our philosophy? They're the result of 25 years of experience and working with clients, watching what works, watching what doesn't, and being honest about the difference. Some of them will feel obvious, some of them will challenge you. At the same time, with only 15,000 financial advisors in Australia and over 16 million adult Australians over the age of 30, our philosophies will not suit all, and our service is not for everyone, and nor do we want it to be. We are high service, increased communication, and focus on risk-adjusted portfolio creation. Let's get into it. Rule number 1, begin with purpose. It sounds almost too simple to be a rule. Before you invest a single dollar, you need to answer one question. What are you actually trying to achieve? Are you building a retirement fund, preserving capital for the next generation, generating income to replace a salary, funding a business in 10 years? Each of these goals demands different strategy, a different time horizon, and a different appetite for risk. The problem is that most people come into investing the wrong way around. They see an opportunity, a stock, a fund, a property deal, and they jump in. Then they reverse engineer a reason. That's not investing, that's speculation with extra steps. Purpose is your anchor. It's what you return to when markets get choppy and your instincts are telling you to do something rash. If you know why you're invested, you're far less likely to make decisions that undermine your own plan. Before anything else, get clear on the destination. Rule number 2, understand what you own and why. This one follows naturally from the first, but it goes deeper. It's not just about knowing the goal, it's about understanding every single holding in your portfolio and being able to articulate clearly and simply why it's there. If you can't explain why the investment does, how it generates a return, what the risks are, and why it belongs in your portfolio, you shouldn't own it. This matters especially in periods of complexity and volatility. When markets fall, the investors who panic are almost always the ones who didn't fully understand what they held. They bought a fund because a friend recommended it or because it had good 3-year track record and they never looked under the hood. This goes back to the purpose of your investment. If you aren't comfortable with volatility, then why are you chasing the returns? Because reward requires risk. Understanding your investments also means reviewing them. The reason you bought something 2 years ago may no longer apply. Businesses change. Market conditions change. Your own circumstances change. A holding that made sense that might be a liability now. Know what you own, know why you own it, and keep asking the question. Find yourself an advisor that can explain the why. Rule number 3, diversify assets, income, and vehicles. When most people hear diversification, they think of not putting all their eggs in one basket, and they're right, but they're only thinking about half the picture. Yes, you should spread your investments across asset classes, equities, bonds, property, infrastructure, alternatives, and cash. Different assets behave differently at different points in the economic cycle, and that variation is what gives a diversified portfolio its stability. But income diversification is just as important. If all your income comes from one source, a single employer, a single business, a single rental property, then your financial life is fragile, regardless of how well you've invested your capital. Building multiple streams of income over time creates a buffer that no amount of portfolio diversification can replicate on its own. And then there's a third dimension, investment vehicles. The structure through which you invest matters enormously. Superannuations, trusts, companies, personal, joint. Each has different tax treatment, different accessibility, different rules. Diversification of tax expense using the right vehicle for the right purpose isn't a detail, it's a fundamental part of the strategy. Diversification is one thing, it operates on 3 levels simultaneously. Get all 3 right. Rule number 4, stay invested and let compounding work. Now, Albert Einstein reportedly called compound interest the 8th wonder of the world. Whether he said it or not, the principle holds. Compounding, which is the process of earning returns on your returns, is the single most powerful force in long-term wealth creation, and it requires only one thing from you, patience. The investors who consistently outperform over decades are rarely the ones who make the cleverest trades. They're the ones who stay in the market through good years and bad and let time do the heavy lifting. Here's the problem. Markets are volatile. They fall, sometimes sharply, sometimes without obvious reason, And when they do, every instinct tells you to get out, to wait for calmer waters before getting back in. But timing the market is, for almost everyone, a losing game. The mathematics are brutal. If you miss just the 10 best trading days in a decade, your returns can be cut in half. And those best days always come in the middle of the worst periods, when fear is at its peak and conviction is at its lowest. Slow and steady doesn't feel exciting. It doesn't make for good dinner party conversation, but it is overwhelmingly what works. Stay invested within your risk tolerance and let compounding do what it does. Rule number 5, know your behavioral bias. There will always be something to worry about. Always. Risk of war, an upcoming election, a banking crisis, a pandemic, a rate decision. If you wait for the world to feel safe before you invest, you will wait forever. And yet, markets over the long term have absorbed every one of those shocks and continue to climb. But the human tendency to extrapolate the worst case scenario indefinitely is one of the most reliable destroyers of investment returns. This is the territory of behavioral finance. Loss aversion, the fact that we feel the pain of loss roughly twice as acutely as the pleasure of an equivalent gain, causes people to sell at exactly the wrong moment. Recency bias causes us to assume that most recent trend will continue forever. Herd behavior causes us to buy what's already expensive and sell what's already cheap. The first step is simply knowing these biases exist. The second is building a process that accounts for them, rules, checkpoints, an advisor, a framework, something that introduces a pause between the emotional impulse and the investment decision. Your biggest risk in investing is often not the market, it's yourself. Rule number 6, respect market cycles and their limits. Markets move in cycles. Expansion gives way to contraction, bull markets end, bear markets recover, credit tightens, then loosens. Valuations stretch, then compress. This has been true for as long as markets have existed, and there is no reason to think it will stop being true. Understanding where you are in the cycle and positioning your portfolio accordingly is one of the most valuable things an investor can do. It informs how much risk to take, where to find opportunity, and where to be cautious. But here's the important caveat. Markets do not always behave as the cycle suggests they should. Valuations can remain stretched for years longer than anyone expects. Recoveries begin before the bad news has stopped. The cycle tells you roughly where you're headed, but it doesn't give you the precise route or the exact timing. And then there's strategic asset allocation, the discipline of working with what you have, not what you wish you had. The ideal conditions for investing rarely arrive. The investor who waits for perfect clarity will always be waiting. You play the hand you are dealt, you position thoughtfully within the cycle, and you remain humble about what you cannot predict. Rule number 7, separate noise from strategy. We live in an age of relentless financial commentary. Markets go up 0.5%, it's a headline. A central banker clears their throat, it moves currencies. A single tweet, as we have seen, can shift billions in market value. Most of this is noise. Generally useful, strategy-altering information is rare. The challenge is learning to tell the difference. Noise is what dominates the short term. The daily moves, the pundit predictions, the breathless breaking news. Strategy is what matters over the long term. Structural trends, valuations, the fundamental health of the business and economies you're invested in. Noise demands a reaction. Strategy demands patience. The most disciplined investors we know have a very simple test. Will this information still matter in 5 years? If the answer is no, they largely ignore it. If the answer is yes, a genuine shift in interest rate cycles, a structural change in the industry, a meaningful deterioration in the business, then it warrants attention. Build your long-term strategy with care, then protect it from the noise. Rule number 8, the best opportunities arise from panic. This is the rule that most people know intellectually and almost nobody can execute emotionally. When markets fall sharply, when headlines are catastrophic, when fear is everywhere, when it feels like things will never recover, that is historically when the most attractive investment opportunities exist. Assets are cheap. Quality businesses are being sold alongside weak ones indiscriminately. The gap between price and value is at its widest. But to act on that, you have to be able to do something deeply uncomfortable. Buy when everyone around you is selling and hold conviction when the consensus says there is none to be had. This is where preparation matters. The investors who can decisively in a downturn are the ones who built resilient portfolios before the downturn arrived. They have liquidity. They have a plan. They know what they want to buy if prices fall. So when prices do fall, they don't freeze, they execute. Panic is the market's way of creating a sale. The question is whether you're in a position financially and psychologically to take advantage of it. This is where strategic asset allocation matters, shifting the preference of asset classes depending on the opportunity and the risk-adjusted reward. You cannot buy more cheap shares if you're already fully invested in a downturn without cash on the sidelines. This is where also a financial advisor can help. Rule number 9, measure returns in real terms. If your portfolio returned 7% last year and inflation was 5%, your real return was 2%. That distinction matters enormously, and it's one that gets glossed over far too often. Nominal returns are what get quoted. Real returns are what actually increase your purchasing power. And if your capital is not growing at least as fast as inflation, it is, in the most practical sense, shrinking. This has particular relevance for capital preservation strategies. It's not enough to protect the number, you have to protect what the number can buy. An investor who keeps their wealth in cash over a long period may see their balance unchanged, but the real wealth, their ability to fund a lifestyle, support a family, or meet future liabilities, will have eroded significantly. Inflation is a silent tax on wealth. It simply gradually reduces what your money is worth. The goal always is to stay ahead of it and to measure your progress honestly in real terms. Rule number 10, balance resilience against vulnerability. The final rule brings everything together because it asks the most important question in investing. For the return you are seeking, do you truly understand the risk you are taking? This is the essence of what's known as the Sharpe ratio. The idea that return should always be considered relative to the risk. Not all returns are created equal. A 10% gain achieved through concentrated leverage bets is categorically different from a 10% gain achieved through a diversified, well-constructed portfolio. The number is the same. The risk taken to get there is not. Every portfolio has two faces, its upside potential and its vulnerability. A resilient portfolio is one that can withstand a range of scenarios, not just the ones you're expecting, but the ones you're not. It holds up under stress. It doesn't require a perfect environment to function. Vulnerability, by contrast, is often invisible until it isn't. It hides in concentration, in leverage, in illiquidity, in positions that are correlated in ways you did not anticipate. The goal is to not eliminate risk. The goal is to take risk knowingly, deliberately, and in proportion to the reward on offer. To build a portfolio that is strong enough to survive the unexpected and flexible enough to capture the opportunities that follow. That is ultimately what prudent investing looks like. So the 10 rules, not a guarantee, no rules are, but a framework, a way of thinking about wealth that keeps you focused on what matters and honest about what you can and cannot control. To summarize, 1, begin with purpose. 2, understand what you own and why. 3, diversify assets, income, and vehicles. 4, stay invested and let compounding work. 5, know your behavioral biases. 6, respect market cycles and their limits. 7, separate noise from strategy. 8, the best opportunities arise from panic. 9, measure returns in real terms. And 10, always balance resilience against vulnerability. If our philosophies resonated and you'd like to talk through how any of these apply to your own situation, reach out via the Mont Wealth website. Thanks for listening.